Hello, everyone. This is Drew from Best of Us Investors, working with Mark on the Platinum Trading platform. So again, this is another episode with Mark, and Mark has been investing for over 40 years now and has worked as the director of operation for an online firm for around 10 years. He will be doing overviews on what he saw in the market and charts from the previous week regarding swing trades and also share some of the stocks he's keeping an eye on for swing trades for the upcoming week. Now, for real-time buy, sell signal notifications based on more than 7 indicators and insights on stocks that are setting up for great trades each day, along with educational videos on how to read charts, come join our Platinum group and let's get through this tough market together, seeking for great swing trade opportunities and even for great potential entry points for long-term investments as well. So make sure you check the link in the description below for the Platinum membership. And I always say this, but just wanted to remind you that this video is not made for financial advice, but for educational purposes only. So Mark, how was the market last week?
Well, the market was all over the place last week. What do you think about the market? You're young. You've probably never gone through this before.
Yeah, so this is a market that I can't understand. It's my first time going through this market, which, doesn't make sense to me. So that's why I kind of bug you every day or like very often to, ask you what's going on. And, it's really helpful to hear your insights because you've been through this market, in the past.
Well, thanks. I don't have a crystal ball, but I just try to use my experience to help you out. And that's why we created the Platinum channel and different channels where people can talk back and forth on this market. So, this is a really strange market because of inflation. We haven't really had, people haven't experienced inflation since the 70s or 80s. And then we've had, years and years of zero interest, cheap money out there that companies could just borrow cheap and then go buy their stock backs and push the prices of their shares up. They buy it at 1%, borrow at 1%, stock goes up 20%. I mean, it's just a no-brainer for them. And then we had, during the pandemic, we had a lot of growth stocks that didn't have any earnings, they had revenues, and they would go out and they would get either offerings, diluting shareholders, or they would go get financing, cheap financing to run their operations. And now that money is no longer there. That money is expensive now. And we're going to see the ramifications of that. You've already seen it in the market on companies that don't have any earnings. So right now we're really a market that's trading on the news, and it's trading on whatever the Fed says or whatever report comes out, and we wait for we get a report, the market goes up or down, and then we flatten out and we wait for the next report. But the charts do tell us something about the market. And so that's the only sanity I have when I'm looking at the markets, long-term and individual charts. So the fun really began right here. And this was last Thursday. And this was when Powell came out with his speech. And, somehow the market took it as, okay, we're only going to do 50 basis points and then we're going to stop, or I don't know what the jubilance was, but that's not what he said. What he said is, we have the propensity to only do a 50 basis point rate hike in December, but we're still going to see that the terminal rate will probably be higher and for a longer period of time. Well, somehow the market just went nuts, and I don't know if the algos kicked in or what. So then the next day, you can see we had a stronger than expected payroll report, and we just kind of stayed flat. And one of the things I want to show is, we're in an ascending wedge, and you can see right here these blue lines, an ascending wedge, which comes to an apex. And you see right here at the Powell speech, that's where we hit. The next day we hit, and then we also touched on the long-term bearish trend right here. We never went past them. We were up above the 200-day moving average. As you can see, we're not there anymore. Right here, okay, this was the weekend. This was Friday. So right here, this is the 5th of December, which was Monday. We closed down 483 points because we had a better than expected service sector activity report. So we closed down below the 200, and you can also see we closed down below the 9-day simple moving average. So then on the next day, which is right here, this is the 6th of December. The 6th was Tuesday. We closed down another 350 points on the Dow. We had recession fears from CEOs who came out and basically said, they're laying off. We're seeing slower economic growth. We're seeing customers that are downgrading on their purchases. Basically, a pretty gloomy report from CEOs who see it real time. So that's why they're saying this. So again, the market went down. So then on the next day, you can see on the 7th, which was Wednesday, we traded down a little bit to flat because we were waiting for the jobless claim, the PPI, and the consumer sentiment report. So basically, we're waiting for reports, and we went down flat. At this point, I said we could have a bounce. I put this line in here and maybe have a retracement up and then down. So on Thursday, the markets closed up about 183 points, which isn't much. Again, we're just waiting on the PPI report and the consumer sentiment report. And then today, we had a hotter than expected PPI this morning. Before the report, the markets in pre-market were up. And then after the report, pre-market went down. And then we came back up, and now we're trading about even again. So again, we're waiting for next week, which is when we're going to get the CPI. And also the Fed's going to come out with their rate hike, whether it's 50 basis points or 75 basis points, we're going to get a rate hike. But it's seen a downward trend. We broke through this wedge, ascending wedge, which is bearish. We're down below the 200. We couldn't get above the bearish long-term trend. You can see that now we're going sideways. Down when we look at the MACD, you can see that the MACD is below the signal line. We have a little bit of a crossover on Stochastic. And we look at the RSI, we're sitting at about fair value. So the markets they're looking a little tired to me, especially the S&P. The Dow looks the same way. So expect more news-based movement next week.
Well, thank you for sharing that, Mark. So I do see that it was a really, really busy week, but even in this market, so regarding last week, were there any stocks that you kind of thought was worth swing trading? Can you share some?
Well, we were into Juniper Networks, and we got in and then we got out, and we got back in after they went ex-dividend. And it worked out pretty well. And last week or this week, we got back in on the 30th of November. We bought it 31.54. Let me go to a chart here and I can show you. So you can see right at this point right here, which is the 30th of November, we got back in as the price action went down below the 9-day SMA and we hit. And this line here is when we bought. Then price action went up and then came back down. And again, once it went back below the 9-day SMA is when we got out. And we got out at 32.05, which is this purple line. This is where we're at today. We're just hugging that 9-day simple moving average. We made 51 cents a share. So if you had a 100 share lot, you'd have made $51, which basically would have paid for your December subscription to this Platinum channel. So it's tough right now to find swing trades out there, Drew, because with the market going sideways to down, the setups just aren't there. But we need those markets to swing down so that we can find setups. So we just need to be patient at this point. I'm in no hurry to go out and lose money. I want to make money on swing trades. And swing trades is all about being patient and letting the markets come to you. So one we've been watching has really been resilient in these markets is Procter & Gamble, symbol PG. And you can see for the last 13 days, once we got above the 200-day simple moving average right here on price action, right here, we've had steady gains up, and it's just following this nice ascending 9-day simple moving average. And you can see we're ascending up even with the market going down. We're still about a little over 5% to the resistance line. So there are positions out there, and P&G is a good, strong company. They give dividends. It's something that people need, staples. And so during economic rough times and inflation, that they're going to make some money too. So it has some good fundamentals. So there are some out there for swing trading, but you can see this is just a slow, steady rise up. As long as you're above the 9-day simple moving average, you don't close below it. You could stay in this position if you happen to get in. We go down and we look, at the MACD. MACD is still above the signal line. We have a nice little ascending percent K line on the slow stochastic, and we have a nice 74.9 on the RSI. And you can see the RSI has been running above the 70 line for quite some time. So you can find them out there, but they're few and far in between. So this is the long-term chart, and this goes back to 2019, July. And you can see basically here's where the pandemic was and what happened, and we came back up. This is the 200-day simple moving average. So we went above the 200-day, back in June of 2020. And we've been above it and the 50, all the way up to this point here back in January. And right about here, we started heading down. And at this point in February, we crossed the 200-day simple moving average. We did it here, popped back up, and we haven't been above it since on the S&P. So, this is the point Whereas an investor, that this is where I got out of index funds and everything right here because of this right here, because it crossed the 200-day moving average. And as you can see, we haven't been back up, and now we're coming back up to it. So this is the market we've experienced this year. Okay, so here's January 4th where we hit the top. Okay, and this is the S&P daily chart. And since that time, you can see we're above the 200-day simple moving average, meaning we were in a bullish trend. Since that time, we started coming down. We crossed below the 9, briefly underneath the 200-day back in the end of January, crossed back up, came back down. So we're basically bouncing off the 200-day. And here is where we started with our bullish trend line. You can see from here to here that we're heading down now in the market. From that point, we went over, we came back up, and we touched on the 200 again about in April, and then dropped down below the 50. We're below the 9. And this is the market in general, below the 20. Came up, did a little swing, came back down. We're still way below the 200. Okay. And at this point, right about here in July, we started seeing a rally come up. Well, this rally turned in. You can see we crossed back over the 9. We crossed back over the 50. And it became an ascending wedge. You can see an ascending wedge is where we're wide down here. We get narrower and narrower. And these are usually bearish and show a trend reversal. So here at this point, about in August 16th, we just tapped on the 200-day simple moving average. And again, here's another point for our downward descending bearish trend. From that point, we moved out of the ascending wedge again and came in to another dump. You can see we came all the way back down until just about, well, I would say October, middle of October. We had a nice big candlestick here. And again, we started forming another ascending wedge, as you can see. Right here, we came back up, went through the 200-day simple moving average, bounced off the top line of the ascending wedge, never got to the trend line, basically just tapped it, and again came back down, and we broke through the ascending wedge again, and here we are underneath the 200, underneath the bearish trend, and underneath the ascending wedge. You can see what happened over here. The same thing is happening right here. So in the technical analysis, we'd be pretty much predicting that we're going to probably see something like this. Now, nothing's for sure, but it sure looks like that's going to happen from what I can see, Drew. So if we go back and we just kind of move in on this last wedge we had here, you can see something else in technical analysis is we had a gap. And a gap is the difference between price action. You can see here we closed down on the 9th of October, and the next day, okay, the high that day was 38.18, and then the next day we opened at 90 or 39.58. So we have a gap right here. And a lot of times, you know, especially on these indices, we have to come back and fill that gap. And I think that's where we're heading, to fill this gap right at this point down here. And if we do, that's right about at the 50-day simple moving average, which would become our next resistance line. If we broke through that, that would, or support line, I should say, this will become our next support line, the 50-day simple moving average. If we break through that, it'll turn into resistance. You can see we're already playing with the 20-day simple moving average right now for the last 3 days. It's acting as resistance and support. We just don't know which way it's going to go. But the indicators down here, the oscillators, would tell us it's looking like we're going to head back down.
Wow, Mark, thank you very much. That was a lot of great insights, not just for swing trades, but looking at the market in macro using the charts. So thank you very much for sharing that. So I did learn a lot again from this video, and I hope the subscribers who are watching this video has learned a lot as well. So thank you very much all for listening, and I hope you enjoyed this episode. And for more details and updates regarding swing trades and chart analysis each day, make sure you join our Platinum group, and let's successfully invest and make it through this tough market together. Thank you very much, and see you all next week again.